Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 23 of our YouTube channel and podcast, and I just could not be more excited to continue this journey with you guys and teach you more about personal finance topics that I think are pertinent to your life and that you're really going to benefit from long term. Today, we are going to cover a topic that is a particular investment principle that I would like to cover with you, and that is diversification. And so yesterday we talked about a particular investment principle of compound interest and its importance, but now we're going to talk about diversification, and that's what a lot of people mean when they say don't put all your eggs in one basket. You may have heard one of your parents or your grandparents tell you that before. Don't put all your eggs in one basket. And we're going to talk about what that means today when it comes to your investing life. Before we get too far in, let me go ahead and remind you, if you haven't already, go down below and subscribe to this channel and like this video. Leave me any feedback in the comments. I'd be glad to get back with you and have a conversation about things that you may think are interesting or questions that you may have. Also, go to the social media platforms, Facebook, Twitter, Instagram. Follow us at MNO with Dylan. And then you can also check out our website, www.mnowithdylan.com, and you'll find the financial coaching services that I offer there. And you can learn a little bit more about me and what I'm doing and why I like putting out this content for you guys. So all of those things would help me. Also, if you're listening on the podcast, I appreciate you. On Apple or Spotify, if you could just go subscribe to the podcast. And if you want to go listen, you can also go and listen on those platforms and subscribe there as well. So when somebody says don't put all of your eggs in one basket, what are they talking about? Well, basically it's just saying don't put all your resources and your energy towards one thing and really increase your likelihood of losing it. Because if you have a bunch of eggs and they're just in one basket, if you drop that basket, well, you're probably going to lose all your eggs. And so that's really the point of that statement. And so we're going to expound on that and talk about how that relates to your investing life and the things that you do financially. And a lot of times what happens to us is we get very narrow vision. We get tunnel vision on things that we're really interested in or things that we really like, and it makes us take on more risk than is necessary. And so in that way, we put our eggs in one basket. And so let's talk about a couple ways in which we do that. So let's say you work a job and you just have one single income stream and everything you do relies paycheck to paycheck on that one income stream. Well, you're really putting all of your eggs in one basket because you're relying on that job to create income. And single income households, that's kind of putting your eggs in one basket. And it's not necessarily a bad thing. It's just all of your resources and all of your effort is going into this one thing that is providing for you. And if you were to lose that thing, then you would lose the provisions that it was giving. And so single income stream, that's one particular place. Let's say you're investing and you invest all your money into one security or one stock or one bond. That's also going to be a place where you're putting all your eggs in one basket because you're betting on that particular thing to grow for you better than a portfolio that is diversified or has a particular asset allocation would do. And so that can pay off big time. And we'll talk about how that can pay off big time. But it also is making you take on a lot more risk than is potentially necessary. Additionally, another way that we go about putting all of our eggs into one basket is people will quit jobs in order to follow their dreams. And there's nothing wrong with that, but they do it without a plan. And so they just jump into doing this thing that they think is, the next big thing in their life. And there's nothing wrong with following your dreams. I want people to follow their dreams and do the things that are best for them. But doing it without a plan and doing it without any realistic view of what it may take to get there, that's really putting all of your eggs in one basket and taking on unnecessary risk as well. Then lastly, another example is when individuals have too specialized in education. So if you go to school for a long time and you get a very specialized degree to do a very specialized job, and then you realize you don't like that job, well, you put all your eggs in that one basket. You put all your energy and resources towards that one career field, and then realize you don't like it. And so that can be an issue. And so we don't necessarily want that to happen. And once again, it's not that this is a bad thing at all times, but it's making you take on risks that you don't have to take on. So let's just think about this. Some of the richest individuals in the world, and I'll just use three as a quick example. So Jeff Bezos, Bill Gates, and Warren Buffett. How do you think these individuals are so rich? Well, it's because all of their wealth, or a vast majority of it, was invested into a single stock. And that single stock is whatever company that they run. So for Jeff Bezos, it's Amazon. And for Bill Gates, it was and is Microsoft. And for Warren Buffett, it's Berkshire Hathaway. And they own that stock and a high percentage of the company that they either founded or that they were CEO of or whatever. And that stock has gone up in value a lot. And so that's made them very rich individuals. And so what have they done? They've put all of their eggs in that one basket, on that one company, in that one stock. And so you see how putting all your eggs in one basket can really pay off. But that's that risk-return relationship that we were talking about earlier, because we were saying, okay, with higher risk should come higher return. Well, what did I just say? With putting all your eggs in one basket, you're taking more risk than is potentially necessary. And in doing so, that can lead to very high returns, as these individuals have seen, but it can also lead to a lot of negative returns, and it can kind of lead to a detriment on your career and on your success. And so a couple things to remember here. You don't have to have a backup plan, and you don't have to have contingency plans, but you have to be able to deal with the outcomes that can come from being too specialized and from putting your eggs in one basket and doing the things that a lot of people wouldn't tell you to do, and not diversifying, because that's what we're talking about when we're saying putting all your eggs in one basket. You're not diversifying. Mark Cuban says something that I think is particularly interesting. He says diversifying's for idiots, and I don't disagree with the way he was talking about it. But when it comes to the normal individual, the average individual, investing and doing so for the future, a certain level of diversification is important, and it allows you to de-risk. It will allow your investments to grow in a way that is both relatively predictable and will provide you good long-term growth. So I don't want to say that diversification is always stupid. But if, let's say, you're trying to grow a company, or you're trying to be one of those rich billionaires, then yes, diversification is for idiots in that particular case. So what does diversification look like in our investing? So I'll talk about a particular way that you diversify in your investing, and that may be with single stocks. So Warren Buffett always talks about how you can diversify with 6 to 10 stocks. And how do you do that? What does that mean? Well, when the returns of particular stocks are not correlated with one another, meaning, if one is going up, then the other one isn't necessarily going up either as much, or maybe it goes down some, or whatever. That there's a lack of correlation of the stock returns is going to allow you to diversify more. So if you're trying to see if you're diversified, you want to check the correlations between returns on different things that you own. And if everything goes up at the same time and everything goes down at the same time, then you're probably not well diversified. But there are varying views on how many stocks it takes to be properly diversified. For instance, Ben Graham says that, and he's a very influential individual in the investing world, and he was the professor of Warren Buffett, and he says 10 to 30 can allow yourself to be properly diversified. Others argue that greater than 30. But there is a diminishing return to diversification. There's a diminishing utility to diversification, meaning that the more stocks you add, the less utility you're going to get from diversifying, and the less risk you're going to take away from diversifying. And so funds are a particular way that this can be easily done. So let's explain. If somebody is saying that it's going to take 30 stocks to diversify, well, 30 stocks can be expensive for the individual investor, because let's say you're talking about 30 stocks, and let's say the average stock were to cost $100. Well, that means you have to have a minimum of $3,000 just to buy one of each. But then they're going to be weighted differently. They're going to have different weights. And if, let's say, you wanted equal weights, well, it's going to take a lot more money to get there. Or if you wanted to weight by value, well, it's going to take a lot more money to get to that place. And that's going to be hard. That's going to be something that you're probably not going to be able to do, especially in the beginning. So funds help you to do this. So mutual funds and ETFs, what they do is they hold a large number of stocks or bonds or whatever that particular mutual fund or ETF is tracking. And what they allow you to do is they allow you to have the returns that come from this group that they're invested in. And this group can be up to thousands of securities in these particular funds, and you can buy them very cheap. So for instance, the S&P 500 index funds that are offered in ETF or mutual funds, a lot of them are selling, $150, $200, $300 per share. But if you were to go and buy the whole S&P 500 in the particular weights that's set by the people at Standard & Poor's, then you would not be able to do that likely. Or if you're able to do that, you have to have a lot of money to be able to do that. And a lot of time, and it would take a lot of effort. And so funds are going to allow you to do something at a low cost that you can't do yourself otherwise. And with funds, it is a little harder to understand what you are actually holding, and all of the stocks or all of the bonds or all of the whatever that the fund is holding. And that's not a horrible thing, but you want to have a good idea of what you're tracking with, and what the particular fund is holding, the type of company, the type of debt, the type of things like that. So for instance, with stock funds, you may have small cap, mid cap, large cap. They even have some mega cap. Well, and what this means is, smaller companies, medium-sized companies, larger companies, huge companies like your Apples, your Amazons, all of those. And so you understand that this particular type of fund is going to hold these different sizes. Well, you can also diversify yourself by the size. So if you buy a S&P 500 mutual fund or ETF, well, that's going to just be large cap. Well, you can diversify yourself by buying mid cap or small cap or both mutual funds as well, and allow yourself to diversify the stock portion of your portfolio. In a similar way, if you're holding bond funds can come in many different ways too. They can be corporate bonds and government bonds, and they can be short-term or intermediate-term or long-term, and you can diversify yourself throughout that particular asset as well. And what that is going to do for you is you're going to have returns that aren't as correlated as they would have been before. Therefore, you're not putting all of your eggs in one basket. And the common misconception is that, let's say I buy one total market index, so something that tracks the entire market, small, medium, large stocks, and I just buy that one fund and I put all this money into one fund. The misconception is that that's not proper diversification. Well, I'm going to be owning stocks that far exceed the number that they say you need for diversification. I'm going to own stocks of many different industries and many different sizes and many different categories. Like some are value stocks, meaning they have low valuations, and some are growth stocks, meaning they have really high valuations. And so you can diversify with just one fund, and that's why they're so useful and can be a good tool for your wealth building and a good tool to implement diversification in your investments. Now, personally, I hold both mutual funds and ETFs of differing types, and I also hold some single stocks that I kind of follow Buffett's idea of how to diversify your single stocks, no more than 6 to 10 that aren't heavily correlated. So you can do a little bit of both and allow yourself to diversify, yet still get really good returns in the long term. Now, a particular misconception that there is about diversification is getting it mixed up with asset allocation, which we will talk about in tomorrow's video. And asset allocation is mixing up different asset classes. So holding a certain percentage of stocks and a certain percentage of bonds and a certain percentage of commodities or a certain percentage of cash or whatever it may be. And so you're playing with that mix. Well, that's not diversification. Diversification is within an asset class. You can only diversify yourself within a particular asset class. So you have to play with both diversification and asset allocation. And we'll jump more into that tomorrow. But I wanted to make the distinction today. That way you don't think, well, okay, if I own stocks, well, buying bonds that are not correlated, is that diversification? Well, that can have a lot more to do with your asset allocation. And we'll talk about that later. And diversification relies on asset allocation to continue de-risking and taking out the unnecessary risk that is inherent in a particular portfolio. And so just a quick aside here that is very important to understand. So this idea of diversification and asset allocation and taking risk off by mixing up what you own and the types of things that you own. Well, this isn't a new concept. So this is actually an idea that is covered in the Bible. And again, if you're not a believer, I'm not trying to offend you in any way or take anything from you, but I do want you to hear that this dates back centuries and thousands of years to these individuals had the same ideas. And so this is a particular scripture from King Solomon, and it's in the book of Ecclesiastes, and it's chapter 11, verse 2, and it says, "Divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth." So what is Solomon saying there? He's saying, don't put all your eggs in one basket. Split it up to 7 or even 8. So he's saying, you don't know what's going to happen, therefore split up what you own. And so that can be directly tied into the way you invest. You don't know what's going to happen, so split up what you own. And I just think that's really cool. I think that's a cool thing to be able to look back and go, well, this is not a new concept. It's not something that a bunch of finance PhDs just conjured up. It may have a fancy name to it, but the concept is old, and the concept it has paid off in the long term. So let me read you this example, and it practically tells you what diversification could look like. And so it uses some larger numbers, but it also allows you to see what we're really talking about here. So let's assume that you work for company XYZ, and this is a beverage company. So this is something similar to a Pepsi or Coca-Cola or something like that. And you have $1 million to invest. And then let's further assume that you could invest all $1 million in the employer's stock, so in that beverage company, or you could invest 50% in the employer's stock and 50% in company ABC, which is a healthcare company. Okay? And so if you invested all $1 million in company XYZ, and let's say the stock goes for, we're going to use small numbers just for simplicity. Let's say it goes from $4 a share to $2 per share. Well, your portfolio loses 50% of its value. So you go from $1 million to $500,000. Now let's assume that you invested $500,000 in company XYZ and $500,000 in ABC. So you split 50-50 like we were talking about. That was the second part of the example. And let's say the company XYZ stock goes from 4 to 2 like we just said. So that part cut in half. But the company ABC stock, which has very little in common with XYZ because they're in totally different industries, let's say that particular stock goes from $6 to $7.50. So the result is that $500,000 of your initial investment is now worth $250,000. So that was your employer's stock. It went from $500,000 to $250,000 because it cut in half. Okay, and then the other $500,000 is actually now worth $625,000 because you own that healthcare stock as well that went up in value. And so at this point, your portfolio goes from $1 million to, if you do the math, $875,000. Now, this is still a loss, but it's not the $500,000 loss that you had before. And why? Because there was some diversification, not a lot of diversification, but you bought something that wasn't correlated with the other asset that you held. Therefore, that thing went up in value some when your other asset fell hard in value. So you can see that in this very simplistic example, and it doesn't always work out this way. It could very well work out where they both lose or whatever. But this is an example of how uncorrelated assets can move in opposite directions, and you can minimize your losses and minimize your risk in this way. And let's be clear about this. You can over diversify 100%. You can over diversify. Some may even argue that mutual funds are over diversifying because they hold so many different stocks or bonds or whatever it may be. But let me tell you a couple of ways that you particularly may be over diversifying. So first of all, if you own mutual funds or ETFs that are of the same type of asset, so let's say large cap US companies, well, you're going to have a ton of overlap in what those two mutual funds hold, and they're going to be highly correlated with one another anyway. So you're not really diversifying by holding funds of different names. So in your attempt to diversify, you didn't do that. So yeah, you tried to not put all your eggs in one basket, but it didn't matter because you end up holding some of the same things anyway. So that's a way that could happen. Also, buying too many individual stocks can also get you caught up in that way, because a lot of individuals invest in what they understand and invest in what they know. And they should. You should invest in what you understand and know, but that can be a narrow part of the broader market. So if you start buying a ton of things, a ton of different stocks, well, you'll realize, like I said earlier, that the marginal utility of buying another stock, so the amount of risk that you're going to be able to take off of your portfolio by buying another stock is going to be greatly diminished. So don't overbuy individual stocks just in the name of diversification. You can, I agree with Buffett, you can diversify with 6 to 10 stocks, but you do have to be very diligent in what you buy. Also, individuals get into this thing where they use these multi-manager funds and these funds of funds. So basically they'll hire asset managers to set up mutual funds or these particular types of funds that hold other funds. And it's diversification you could have done on your own, and you're going to pay too much for it anyway. So I would just say that's just too much. It's too much to try to, de-risk by buying funds of funds. It's just not going to do you as much good as you really think it is. So don't overdo it in that way with your diversification. And also thinking that owning equity or debt of private companies that are just like the public companies in the name of diversification will be any different. Maybe the level of diversification that you try to get by simply buying a private firm versus a public firm is not really going to pay off for you. Those are likely going to move in similar directions if you think that a particular industry is going to do well. So if you do buy private, if you do have access to private equity and you do have access to private firms to invest in, which a lot of people don't, then don't get in the habit of buying them simply to try to diversify from the public. Yes, you can find some pricing differences, but the general direction of the investment is going to follow what the industry does. And so just don't fall into that trap. It's just too much diversifying can lead you to just spinning your wheels for no reason and being overly costly, because if you do have access to private investments, it is very costly to do that. And so doing it simply in the name of diversification, not worth it. The bottom line of today is that we all need to take heed of not putting all of our eggs in one basket, but we also don't need to overdo it. We don't need to, be slicing our eggs into particular, little slivers in order to just put a little piece of that egg in each basket. And that's probably a bad analogy, but if you get what I'm saying, you don't want to overdo it. You don't want to try to save yourself from risk so much that you may be missing out on returns, or you may be taking on undue cost. And so we're going to continue on this way of these investment principles that I'm talking about. And we're going to talk about tomorrow asset allocation and how that plays along with diversification, and how asset allocation is actually the mixing of different asset classes and not necessarily just how you invest within a particular asset class. So we'll talk about that tomorrow, and that will help you to see how we can further de-risk a portfolio in a responsible way. But what I want you to take away from today is make sure that you have some level of diversification and some level of comfortability with what you're invested in, and that the risk matches what you want to have as a return. So if you have an expected return and your risk doesn't match that, or your risk doesn't pass the sleep test, and the sleep test is, can you sleep at night with the amount of risk that you're taking? And if that's not the case, then maybe you do need to de-risk some, and you can do that by implementing a further level of diversification in many cases. When it comes down to it, if you're trying to diversify, make it as simple as possible, but no simpler. Don't try to go too far in the direction of making it too easy, but make it to where you're well diversified, and you can understand what you're invested in, and you can make really good returns while still being prudently taking risk off as necessary. So hey guys, thanks again for watching this episode of Money's No Object. I'm really thankful for you guys and your viewership and your listening, and that's just, it warms my heart to see that people are actually interested in these topics. So I really appreciate you. If you haven't already, go down below and subscribe, like this video, leave me some comments, subscribe to the podcast on Apple and Spotify podcasts. Follow us on social media at MNO with Dylan. I put out a lot of good content there. So you can go check that out. Also, check out the website, www.mnowithdylan.com. Also, there's tools for you to use there, and there's financial coaching resources that you can sign up for there, and all of that stuff can be really helpful to you. And so, like I said earlier, look out for tomorrow's video on asset allocation. That will really build off of today's video. And then be looking for the weekly rewind at the end of the week, and that'll probably do you a lot of good, because a lot of these topics are interrelated, and if you miss something, you can see what I'm talking about in a particular video if you missed the previous or a video that was a couple behind. So thanks again for tuning in to this episode of Money's No Object. I am your host, Dylan Howell. God bless.